for joining this event. We were talking about one of the many issues facing property owners and property investors right now, and that is property insurance and just how that market is shifting and just the many pressures that those owners and investors are facing. Robert, you want to take it from here?
Yeah, this is Robert Salwasser. I'm the president of Income Property Specialists. Along with Clay, we work together as principals in the company. We're an asset management firm specializing in the management of apartment buildings throughout the San Francisco Bay Area. We are thrilled to have two presenters, two experts in their field regarding property insurance. Nancy Wallace, who is a professor at UC Berkeley, I believe in the finance department, as well as John Kempton with an insurance risk company. And I don't want to get too far into it. I'll let them introduce themselves and give a brief bio of their backgrounds. Nancy?
Thank you very much for having me. It's really a pleasure to be here. As Robert said, I'm a professor at UC Berkeley, and I run a center. And we've spent a great deal of time and effort in collecting very detailed information on both climate risks affecting real estate. My center is the Fisher Center for Real Estate and Urban Economics. And I also run a lab, which is called the Real Estate and Financial Markets Lab. And we have petabytes of data. We have all the properties in the United States, all the mortgages on the properties, all the bonds that are funded by those mortgages. And then in California, we have very detailed information. And our particular focus has been wildfire. I mostly work on the mortgage markets. That's my specialty. And we are working very hard to develop new mortgage markets to help with mitigation, so fire hardening of real estate in the state, and getting probably tax lien type loans, but we're looking at other things and working with the capital market providers, both banks and securitizers, to get this market up and running. Thanks for having me.
Thank you, Nancy. John?
Hi, I'm John Kempton. I work with a company called FHS Risk. We are an outsourced risk management consulting firm focused on the real estate and hospitality space. We spend our time being engaged by clients to help them figure out how to structure insurance programs in an increasingly difficult market, how to buy insurance most effectively. And then from a contractual basis, how to transfer risk where possible to third parties, and how to mitigate risk by virtue of various upgrades that you can make to assets, upgrades that you can make to the properties in terms of sprinklers or fire bots or things like that oftentimes have a positive impact from an insurance perspective. So happy to be here and look forward to the conversation.
Thank you.
Thank you. Thanks, everyone. All right, let's get into the meat and potatoes here. The property insurance market in California and some other states like Florida and Texas have seen significant premium increases over the last few years. Why is that?
Well, it has a lot to do with the regulation in the state of California. We have a regulatory failure in many ways. Florida is similar. Texas is kind of a runner-up behind Florida and California. But we have built-in frictions in the state that have really impeded actuarially fair pricing. And now some of the major insurance companies are at significant risk. And interestingly, despite all the angst about premium increases in the state, when you look across the country, actually California's rates are lower relative to the risk than any other state in the US. So there are enormous pressures on our state. We can't get away from the risk measurement issues, especially for wildfire, and obviously in Florida for hurricanes. The cost of these, as all of us know, with the Pacific Palisades fire so recently happening, and price tags that are upwards of probably $60 billion, and the stress that's on our state private insurers, the admitted market, and also the California Fair Plan. So it's very stressed. The firms themselves are stressed. There are issues about subsidies and other pricing requests that have been made. and are still now temporary. And so the system that we regulate pricing in the state is leading to a lot of very serious challenges for state insurers, private state insurers.
And I just add from a micro perspective, when you look at property insurance for a property, it's comprised of two components: your property insurance and your liability insurance. And historically, your property insurance has been roughly 20% of the overall, or 70% of the overall spend. And what's happened is since 2017, when you had a triple whammy of storms in Florida, Harvey, Irma, and Maria, capacity has shrunk.
Right.
And that has driven rate increases. But starting in 2020, 2021, at the start of COVID, you also had a great deal of inflation, and that coincided with insurance markets reviewing the insurable values of their properties and determining that in a lot of cases, properties were historically undervalued. And when you look at the components of figuring out property insurance premiums, it's a rate that's applied to your total insurable values. So insurance markets were simultaneously pushing rate increases while they were also pushing a substantial increases in values. So you had this, two-phased approach of increased values at increased rates, and that really drove up property insurance pricing in recent years. And on the liability side, particularly in markets like California, where you have very strict habitability laws, that has also resulted in a lot of litigation. And, either you're seeing markets dramatically increase their general liability insurance rates, or in many respects, increasing the rates and also carving back a lot of those key coverages. So it's been a challenging market where, in the short term, a lot of insurance pricing is really driven by supply demand economics. And that is something where we've seen capacity leaving the marketplace in recent years. And the result is the remaining markets get to dictate a lot of pricing terms.
And in terms of liability, John, what I've seen, what I've heard attending other events, talking to people like you and Nancy, in terms of the liability, California is one of those special states, as you mentioned, the valuation of the properties have just ballooned, right? And so it's actual dollars that the insurance companies are having to provide. And as property, especially apartment buildings, it's a favored asset throughout the United States, just because supply and demand and the money that chases it, valuations going up. But also in terms of liability, there have been a number of nuclear verdicts, and a nuclear verdict is any litigation that results in a verdict over $10 million. You've got law firms. Well, I think 50% of the television commercials here in the Bay Area are for injury, personal injury, and other lawyers advertising their wares and their experience. That's probably not helpful for the industry either. But also more and more litigation, and litigation that's funded by outside parties that will fund the law firms and take a portion of the verdict that they get. And that's called third-party litigation funding. And there's just a lot of exposure to that. And California is just one of those litigious states. Yeah.
Absolutely. And I think what's happened with liability insurance is there's a long tail risk associated with it. So in many cases, if you've got a 2-year statute of repose, somebody may slip and fall on your property today. They may file a suit against you 2 years from now, and it may take 5 to 7 years for that claim to work its way through the court system. And what that did was it means that a lot of these changes in the litigation market took years to develop. And what happened is if we look back to 2018 to 2020, the liability insurance rates in many cases were 25 to 30% of the prices that they are today. So the carriers have driven significant increases, but these carriers are looking back at a 10-year span and saying, I haven't been profitable over this 10-year period, because they're looking back at when they charge 25% of what they're charging today, and they're not able, they're not in this market where you've got very limited supply, particularly for multifamily. It's a favored asset class of investors. It's a hated asset class of insurers, right? From a property standpoint, you have more wood frame assets than you tend to do with commercial assets, and you have people living in these properties. They're sleeping there, they're entertaining there, and that just raises the risk profile of the assets. They've
Yeah.
got stoves, people leave pizza boxes. So property, it's a challenging asset class. Liability, it's a challenging asset class, because people are coming in and out of the properties at all times. And in this environment, unfortunately, what we are seeing is, regardless of the perceived liability of a landlord, from a claim standpoint, because the landlords are perceived to be well capitalized owners with a lot of insurance that's behind them, you're oftentimes going to be the one that's stuck holding the bag. And your insurers oftentimes are taking that responsibility to defend and indemnify you from third party claims. However, these insurers, they're making economic decisions for themselves, not necessarily for you. So we're seeing increasingly carriers roll over and pay multi-million-dollar claims on incidents where you as a landlord would say, there's no way that I am liable for this type of incident. Somebody invites a guest to their premises, an altercation happens between that resident and that guest. That guest is oftentimes going to file a lawsuit against the resident and the landlord. And if
Mhm.
if the resident does not have anything to, any financial mechanism to backstop their liabilities, that's ultimately going to come back against the landlord. And as a consequence of that, that's just, the carriers are paying those claims, and then they're charging those costs back to you in terms of future premiums.
Yeah. As just a
And
final
we
note on this topic, I would just add, because IPS we've got over 40 years experience managing apartment buildings. A tip that I would give the viewers, the apartment owners watching, is that keep every insurance policy you've got. And even if it expired 3-4 years ago, you want to keep your insurance policies, the actual policy, not the deck pages, right? Not the certificates of insurance. You want the actual policies covering your property
Yeah.
liability. You want to keep them forever. And that's coming from lawyers saying, we want to see what the policy was at the time these actions had happened.
Yeah.
Can I mean, I agree
Yeah.
about the liability insurance, and obviously the pressure on property values in the state has been very significant. I mean, actually, that's the good news. The state is a very important economic driver in the United States. We're the fourth largest GDP in the world. I mean, these are very big positives about the state. But the other reality is that there's a real risk here. I mean, the two
Mhm.
costliest climate related risks are hurricane and wildfire. And California is ground zero for wildfire. And understanding the measurement, and I'm talking about at the micro level. There was recently a really interesting study about the Pacific Palisades fire, and they admitted that property owners need to know at their address level what the real risks of that address is, because it matters a lot. There are very important microclimates in California, and we are particularly exposed to wildfire risk. And the insurance companies need to start pricing it, and they haven't been. And that's going to put pressure on premium.
Mhm. Okay. Thank you, guys. It was touched on a little bit earlier, but we've heard many discussions around insurance carriers leaving the state of California, like State Farm and
Yeah.
others. Do we expect that to continue? Do we expect other carriers to enter the market? What dynamics do you guys see there?
The temptation to enter California market for insurance companies is huge.
Mhm.
Exactly what you've been talking about. Apartment stock here, the residential real estate stock, and of course, all importantly, the automobile insurance market. So they're here to stay. Whether State Farm will stay is up as a big question. They have a
Yeah.
temporary rent increase of 17%. They claim they can't function at that level. They've taken quite a significant support from their parent of $400 million as a backstop, just to meet the requirements of California and capital structure. And that's not good news. But I think if pricing becomes more based on the risks, firms are going to enter the market. Some firms will leave, but others are going to enter. And so I'm less worried about just having no insurers here than having a regulatory structure that doesn't enable free and fair entry into this market and allow pricing that's commensurate with the risk that people are exposed to.
Yep, and I think what you're seeing in the broader market is since we had this 2017, this very bad hurricane year, the market's hardened, and historically the property market has been very cyclical, where it's a short, sharp, hard market cycle, and then it's kind of a long softening where capital leaves at the bottom of the market. There's a large insurable event. Capital flees, pricing spikes. Capital says, "Oh, I can make money at the top." They all come in and they chase each other down to the bottom again. What was unique about this last hard market cycle is the duration of it, where we saw rate increases starting at the end of 2017 all the way through the start of 2024, when markets started to stabilize with stable reinsurance renewals, and then towards the second half of 2024 started to come down. That has exacerbated in 2025, particularly on the large commercial side, where property rates are really starting to come down. It's the challenge is it's not so much, you're not seeing a lot of new capacity come into the space, particularly true new market capacity. What you're seeing is existing markets looking to continue to grow.
Mhm.
I think where you'll see more growth is not in true new insurance carriers enter the space, but the increase in MGAs, or managing general agents. These are effectively outsourced underwriting companies who are given the ability to underwrite on behalf of one or more insurance companies. These have taken off in recent years, and they're seeing significant multiples at exit. So you're seeing an explosion in this MGA space. And I think that's where you'll see probably more expansion in the near term. The challenges with these types of markets is that they tend to be a lot more fickle, where if a carrier makes an underwriting investment, they're investing in the longer term. If
Mhm.
they give their capacity to an MGA and that MGA falls flat, like, they can pull that capacity after a year. So there's a lot more, I'd say, volatility risk in the market, and I think that's what we would expect over the next few years is increasing, just continued volatility in these markets, because the capacity is not particularly stable.
Yeah. John, you mentioned the long tail kind of nature of the market, that there's a huge increase and we're starting to see some of that tail off. What else do we need to see for those premiums to start to drop, and when and if should apartment owners expect to see a reduction in their premiums?
I think property markets, it's cyclical, right? We've been fortunate that 2020, throughout this hard market cycle, we were seeing increases since 2017. And then in 2023, reinsurance rates really drove a very substantial property increase. The reinsurance renewals in January 1st, 2023, the general rule was double, half, where reinsurers who provide insurance to insurance companies, they doubled their retentions. So if they sat excess of $150 million in risk that they would take from AIG, they said, now we're sitting excess of $300 million. They doubled their premium, and they were offering half the capacity for that risk. So went, kind of went down to the retail markets and resulted in sharp premium increases. Since then, particularly on the commercial side, we haven't seen an overwhelming number of cat events. The wildfires that occurred at the beginning of this year were largely a personal lines loss that did, hit some treaties, but it was largely, the commercial markets were largely exempt from that. So as a consequence of that, these carriers started making money, and they all, you know, they're probably not the sharpest minds at the account level. Where if you think about an underwriter, you think of somebody who's really looking at actuarial models. They're an account executive who's they've got a book, and they're tasked with growing that book every year. So they're just quoting new business, and the way you win new business is undercutting the markets. So we're seeing rates come down. I think, knock on wood, we're nearly through hurricane season, and we haven't had a major hurricane event. So if we get through this year without a hurricane event, I think the markets will continue to be quite stable on the property side. The liability side, the issue is it's less cyclical, and it's more like there's an underlying issue that, until the judicial system is changed in the United States and landlords are not stuck holding the bag for everything that goes wrong with their properties or at their properties, um, and you have these poor incentives where there's litigation funding and all of these actors that are, kind of driving these nuclear verdicts. I think you're going to continue to see a lack of capacity, in the liability insurance market, particularly for multifamily owners. Um, or what you're going to see is insurance structures start to change, where you as property owners will start to become, you'll start to be responsible for taking on more of the costs associated with those losses in the form of a larger deductible or self-insured retention.
Yeah.
We're seeing that now when the policies come up for renewal. We're seeing, many things that the insurance companies no longer cover. Mold was excluded from policies years ago. Habitability issues, right? Excluded. There are some fines and damages, I understand, here in California, that the insurance companies, under state law, that they are prohibited from covering under insurance. Things that if a landlord makes an error, makes a mistake, and the city, county, whatever fines them, insurance companies going, no, not covered. So we are seeing that. And at the same point, you mentioned, with hurricanes and flooding in that, through the end of October of last year, there were 20 events in the United States that had occurred, whether it was wildfires, flooding, tornadoes, hurricanes. Each of those 20 events were losses of more than $1 billion, and some of them were multi-billion dollars. And that's real money that has to be spent to rebuild.
Agreed. And that's where the reinsurance market and harnessing its power to reinsure that tail risk is really important. I mean, the good news is that California is allowing reinsurance now in the rate structure. So at least there's the potential to reinsure that tail risk in California. But that's going to push premiums up as well. And the reinsurance market is absolutely boom and bust, exactly what John was describing of the domestic markets and insurance. That's also true of the reinsurance bond markets. So we'll have to wait and see how this all evolves and how this pricing happens from the part of the market that is truly actuarial, and that is the reinsurance market.
And I think, Robert, to your point, over the last 10 years, we've had this emerging risk where, it's called severe convective storm. It's something that California is largely removed from, but that is wind and hailstorm events, tornadoes. that, predominantly were occurring in, Texas, and then it kind of went up through Colorado. And now we're seeing expansion eastward towards Atlanta. And those are now comprising both the majority of the total insurable losses across the United States on an annual basis. And, it's about 90% of those billion-dollar events. And that is something that the markets just, 5 years ago, they weren't underwriting or pricing for. You think about in 2021, there was the Uri storm in Texas where Texas froze over. I mean, that was a multi-billion-dollar event that
Yeah.
none of these models had priced in. And
Mhm.
and even today with hurricane risks, what we've seen in recent years is, you know, carriers are pricing in hurricane risk in Florida, in Houston, up kind of the southeast United States on the coast. But in 2021, we had Hurricane Ian, which disproportionately hit, suburban Philadelphia. That's something that just hasn't been priced into the model. So this impact of climate change, not only are we seeing, you know, the the amount of total insurable claims every year has risen dramatically, but it's the uncertainty of where these events are going to hit is really impacting insurers' ability to appropriately price risk.
I said, yeah,
And then to combine your comment with Nancy's regarding, the climate change and all the regulation that California throws at us. Now you've got, after Katrina, I think it's FEMA that provides the flood maps for the United States. All of a sudden, IPS is seeing properties in flood zones that were never in flood zones before, right? And that's requiring now federal flood insurance, which is just adding to the cost of insurance overall. Um, and in addition, you've just got wildfire zones now in California, and
yeah,
depending on where you are, in the last year or two, we were having a double of time just covering properties, trying to find insurance to cover in a wildfire
Mhm.
zone, right?
yeah.
And here comes along a California plan.
And some of those fire zones, as portrayed, are not accurate. They're not at the specificity at the property level that people need. And I think that's what the Pacific Palisades fire has really pointed out, where really the granularity of these valuations is much more than what these maps really give a sense for. And it's a problem. And we have a measurement problem and sort of has to be all hands on deck, including the universities. I think that's where my institute, that's where San Diego, the UC system is really focused on this. And I think that's the good news, that we can provide better measurement for the industry and for people that own the properties to make good decisions.
Good.
Yep. And I think, Robert, to your point on the flood, I think one thing that's interesting is and is important to understand is lenders are also becoming a lot more sophisticated when it comes to insurance. And historically, if you owned a building in a flood zone, they would require you to buy NFIP insurance, which, it's limited.
Funded yet.
Yeah, which is it's an imperfect product, particularly for
Yeah.
commercial owners, because it only provides up to $500,000 in building
Correct.
coverage per
Mhm.
building. But what you're increasingly seeing is a lot of lenders are now saying, well, I know that that's not really going to help me. So we're seeing a lot of lenders say, I also need insurance up to the value of the first two floors of the property plus 12 months of business interruption. And if you start to do the math, that is, millions of dollars in additional flood limit that you have to purchase. And that comes at multiples of the
Yeah.
cost of NFIP insurance, which is, I mean, it's largely kind of subsidized or poorly actuarially priced.
It
So
is not
there's a
fairly priced. And plus,
so,
right
so
now, unless it gets renewed, it only has $1 billion of capital. So it's NFIP is in shaky ground right now.
Yep. So a lot of these, pricing is in.
Oops.
Oh, we lost
Oh,
John temporarily. We'll bring him back, but um, Clay, maybe we should focus on just the details of policies when John comes back here, and
there we
get into
go.
all the different insurance products available and what's required. There you are,
Yeah,
John.
yeah. So I think we've we've addressed why the insurance market is where it is, and maybe getting some details into where it might be going in the near future. But the question that then becomes is the actual policies themselves, and what types of coverages that these property owners, landlords need between property, general liability, excess liability, umbrella, and so on and so forth.
So when we talk to clients about covering their property, and we will ask for copies of their policies to make sure
Yeah.
that their policies will in fact protect them, right? So you've got the property liability insurance, fire, whatever. You've got general liability, slip and fall type issues. We've also seen and have flood insurance on many of the properties that are required to have it. Some clients that own properties free and clear, we advise that they put earthquake insurance, and that market goes up and down depending on when the last time a part of California shook. As well as I've got clients that have additional policies like boiler insurance and so on. So the types of policies in terms of, and we talked, I think, enough about or hit the major points about property insurance, a little bit about general liability and nuclear verdicts and what covers there. And just with both property and liability, we're seeing more and more insurance companies come back. And I'm sure every owner has received notice that there are no more Zinsco panels that insurance companies are going to cover. Insurance companies are coming back and go, wait, your building was built in 1979? Sorry, we only cover properties after 1980. And most of the Bay Area, because of the age of the Bay Area, when the housing started, after World War II, it's much older than 1980. So you've got those factors as well. The insurance coverage, are there clauses, are there certain policies, John and Nancy, that you would recommend to owners? Because the whole point of insurance is protecting the equity, protecting the legacy that many of our clients have built. As one of my clients told me many years ago, Robert, everybody hates to buy insurance until you need it, and then you wonder why the hell you didn't buy more of it at the time, right? So that's the conundrum we have with insurance. But on policies directly, what do you recommend?
I mean, I think the biggest thing is making sure that your coverage is as broad as possible, right? I think if you look at a general liability policy, for example, it starts out, it broadly covers third-party bodily injury and property damage. And what we're seeing is increasingly, in California, for example, and specifically in San Francisco, habitability is nearly impossible to get. And that's a pretty big exposure for a lot of apartment owners, especially if you're doing unit turns at the property, right? So that is something that, that's something that can get excluded. Now what you're seeing is a lot of either assault and battery exclusions, firearm exclusions, sexual abuse and molestation exclusions. And if we think about those items, those are the claims, you still have coverage for a slip and fall, but if you think about your catastrophic claims, those are the items where you can, you probably have a higher likelihood of seeing a nuclear verdict or something that's catastrophic, that's going to be, a $3, $4, $5 million issue. So it's important as property owners, when you're going to renew your policies, that you're providing the best information that you can to the insurance markets. The insurance market may just get a document that says this is a 1985 apartment. It's a 5-story walk-up with 42 units. It's masonry non-combustible. What you want to provide to them is, here are the updates that we've done over the past few years. Here are our security protocols to ensure that we're mitigating your concerns, and as such, you should give me these coverages. So a lot of times, you're now having to negotiate those back in, whereas you want to be upfront with your brokers. You want to go to them and say, look, this is why I should have all of these coverages. One of the things that insurance carriers are increasingly using is crime scores, which are somewhat backward looking. I would argue that it's kind of a borderlining, a redlining issue. But it's something that they use to determine whether or not they will underwrite a deal. And then if they do, what types of exclusions or limitations they're going to put onto the policy. So the more information that you can arm your broker with as to why you're a good risk, that will help you in the market get the broadest possible coverage with the least limitations. I think the other thing that I would note is there, in certain cases, the carriers may provide, a sublimit for that coverage. What I would always look to is to take a deductible or a self-insured retention for those coverages, because at least, if you have to take $100,000 retention for assault and battery, at least you know that excess of that you have coverage and your downside risk is protected. Whereas a carrier may say, I'll give you $100,000 sublimit for assault and battery, and then, something goes wrong at the property, you know, your downside risk is completely unprotected, and that's what insurance is there to do.
Interesting.
Yeah.
Interesting. Nancy?
So I just a question though about, I agree with everything what John was saying, but there are reasons that these prohibitions on the age of the property exist. Our data shows very clearly age is hugely related to catastrophic loss. A lot of it has to do with the roof. So, people, I agree. Homeowner or property owners need to be very candid about what's old and what's risky of what's old. And I'm hopeful that as we progress with thinking about pricing in a more realistic way, that the insurance companies can have a more nuanced discounting policy if people do retrofit.
And just to add to your comments too, insurance companies, they know their industry. And a few years ago, we would have to provide 3-year loss runs when we would renew a policy, and hopefully they were clean, right? No big general liability, no big issues, right? Well, insurance companies figured out that maybe they ought to look back 5 years, which is what they're doing now, which
Correct.
means if you do have a loss, you're going to be paying for that loss in premium now for a 5-year period, not a 3-year.
Yes, and the insurance companies are using a lot of technology. We can basically now evaluate every single roof. We can look at the damage levels. We can look at the of that building.
Yeah.
And use machine learning to start pricing these policies. And apartment owners should expect more of this.
Yeah. So when we're looking into the specific policies for a specific property, we're looking at the how much coverage owners should be buying, deductible that's appropriate, and getting into details of co-insurance, and what makes sense for the owners is dependent on their circumstances. But just from your high level perspective, what do you guys make recommendations on?
Luckily, I'm not in the business of selling insurance, so I pass this to John.
So with our clients, you're going to need a lot of it. If you have, particularly if you're encumbered by debt, a lot of it's going to be driven by lenders.
Yeah.
I do think as you refinance debt or put new debt on a property, it is really important to try and negotiate those insurance requirements. They are negotiable. And what you want as an owner is to buy the insurance that you want, not necessarily what the bank is going to require you to buy. Property insurance is generally a must. I think depending on your location, you're going to want flood coverage. That is a big exposure. Earthquake coverage, lenders are surprisingly flexible with earthquake coverage in California. The general rule is if your SEL or your scenario expected loss is below 20%, they will not require earthquake coverage. Depending on the modeling, and most of the times your brokers can run earthquake modeling to demonstrate what your loss expectancy would be in a given event. They can run it at the 500-year, the 1,000-year. Most people are purchasing an earthquake limit up to the 500-year return period. In certain markets, particularly San Diego, you will find that properties model quite well. And, you may have a 5 or 6% SEL. In most cases, your earthquake deductible is 5%. So it might not be a good economic buy for you to purchase earthquake insurance when it's the 500-year expected loss scenario, you're retaining 90% of that risk. So those are things to look at is, what is my expected value versus my deductible as these deductibles have ticked up. On the liability side, you want your coverage to be as broad as possible. Habitability, again, in San Francisco might be impossible, but we would, if you can afford it and stomach it, get sexual abuse and molestation coverage, get firearms coverage, get assault and battery coverage. Those are where we're seeing the real nuclear verdicts, the $8 million losses, even on claims where you would sit back as a reasonable person and say, there's no way that I'm liable. Somebody's
Right.
paying out. I do think that the limit purchase is a very tough thing. 10 years ago, it used to be almost free to buy high excess limits of liability coverage. As a consequence of that, many, particularly larger owners, started buying tons of excess liability insurance. There were these programs where it would cost you maybe 5 or 10 grand to go from 100 million in excess liability to 200. So any reasonable person would say, well, seems like a pretty good economic buy. So they bought those limits because they didn't really pay for them. And then as the market hardened, they had a hard time saying, well, maybe I should buy less.
Sure.
In most cases, what we're seeing is that unless there's a claim that goes to trial and there's a jury verdict, 90% of these claims are settled between the insurance companies and the claimant. And in those cases, they tend to settle out, even in horrible scenarios, at the limit of insurance. You look at the Florida condo collapse, that settled in record time. They basically took the entire towers of every single party that was associated with that event and walked away. You look at the Las Vegas shooting from a few years ago, that settled out at the limit of insurance. So there's something to be said about not overbuying limits, particularly in a challenging market. But that's not to say that some people have taken the approach of, I'm just going to cut my limits as low as possible and say, come after me. There's a risk of that as well, where if there's a jury verdict, that jury verdict is a really scary thing to go to. So that's kind of the fine line that you want to take is, don't just buy tons of limit, because in a catastrophic loss scenario, they're just going to come for more of your limit if you buy more.
That's what I was told years ago. Make your liability insurance 20 million, and you're inviting 5 lawyers to join the lawsuit, not one, against you. Yeah.
You had mentioned, the ability to negotiate policy, certain coverages back into the policies. At what level does that make, maybe with a master insurance policy, do you have that leverage to negotiate those specific coverages back in?
Yeah, that's a great point. I mean, in the insurance market, as long as you're not scaling a bunch of property horrible losses, scale means more premium. More premium means more leverage. So to the extent that you can aggregate properties and create some type of pooling of risk, it provides you with more premium, which means you can move up into these kind of up into the more large commercial space. And there you tend to have a lot more leverage in negotiating terms and conditions with these markets. I mean, if you're spending $10,000 a property on insurance, the carriers just, they're going to say it's not worth the risk of providing these coverages. But if you can take 15 properties, each paying 10 grand, and all of a sudden you're now pooling that and paying $150,000, you become a much more important risk to the markets.
Sure.
And you can build a lot more flexibility and a lot more coverage efficiencies into those programs.
John, one of the clauses we see in insurance is co-insurance, and many apartment owners either don't recognize that that's in their policy. It's not always brought forward as part of a conversation with the broker. What is co-insurance, and how does an apartment owner deal with that?
Sure. So coinsurance, think of it as it's a penalty, if you will, where if you have most policies are scheduled values. So the insurable values that you report to the market are the values that you are able to recover. But at the time of a loss, let's say that you report to the market that your building value is $8 million. And at the time of loss, it's determined that that building value is actually $10 million. The carriers will say, well, if I have a 90% coinsurance clause, you did not insure that property to at least 90% of the insurable values. So as such, you're going to have to, even in a let's say you have $1 million loss, you're going to have to contribute some amount to that loss. Well, they'll only give you 90% of the $1 million because you did not insure that property to the right value, and as such, they weren't able to charge the correct premium. This is a key item that can be negotiated off of insurance policies. It's one of the easier things to negotiate off. But what you have to do is validate to the insurance markets, particularly in the current climate, why your values are adequate. Your brokers should be able to do that. They all have tools. It's something called CoreLogic or Marshall and Swift, where they can use the data that you provide them about your buildings, and they can build a replacement cost that they can then validate to the insurance markets and demonstrate that your values are accurate, and as such, there should not be any coinsurance provisions on your policy.
Interesting, because we also see policies that have guaranteed replacement value. There are policies that will have that, extended policies that may go 3, 4, 6% higher than that. So I guess the caution there is you really have to be careful. You have to know insurance. That's the reason for today's webinar, and be able to question your brokers. What's the coverage? What am I?
Exactly. And
what are we buying here?
One of the other benefits of these, master program structures where you're aggregating policies to get together is you can oftentimes, when you build those programs, you have a blanket policy limit of insurance. So let's say you've got 50 properties together. They're all about, let's say they're all somewhere between 10 and $50 million. You may buy $100 million blanket limit, and as long as there are no other restrictions on the program, in each and every occurrence, you have up to that blanket limit to recover for building contents and time element coverages. So if you report a building at $50 million and there's a total loss and it costs $55 million to rebuild, that hasn't pierced that blanket limit, so you'll be able to recover that full amount. That is another big benefit of these master program structures, especially because, in the course of a given year, construction values it's an estimate that you're giving. Nobody knows the exact construction value until the loss occurs. And most importantly, and we learned this a lot in Florida during Harvey, Irma, and Maria, where it may cost $50 million to rebuild your building, but when the entire barrier island gets wiped out and you're in a supply constricted area and now you have a demand surge, the day after that loss, it's now $75 million. So you are reporting an accurate value, but the nature of the loss instantly dictated a change in the replacement cost value of the asset. So these blanket program structures, they provide a lot more of that downside risk, addressing.
Can I just reflect back on the comment, Robert, that you made that you could get guaranteed replacement? I was recently on another panel with insurance people, but it was mostly on residential single family, and they claimed there was no way that was coming back. And this whole issue about actually measuring what the replacement costs are, because of these surges, especially in California with these wildfire losses, the surges are huge.
Interesting. Good to know. And Nancy, you and I have had discussions about regulation, right? I'm not a big fan, But I mean, one of the things you have to along those lines is, San Francisco went through its seismic retrofitting ordinance and process. Oakland, I think, has gone through it. Now the city of San Jose, right,
Mhm.
is now going through it early next year. They're going to have a seismic retrofit program.
Yep.
So at some point, you have to understand that what you may be insuring in January in a property in San Jose, and even though it's a period of time before that property has to be brought up to the codes per the city of San Jose's people, right?
Mhm.
The valuation of the property may change. It may reduce the risk for an insurance company for doing that. So it's not just the insurance companies, the sophistication of the insurance companies. Hey guys, now we're looking at 5-year loss runs, not 3-year, right? We're just going to extend that. Have you pay that loss back a little longer here? And we want to look at what the history of the property longer is. You're also dealing with the regulatory, and not just of the state, but the localities, the
Yes.
cities, the counties.
And the
Nancy,
tariffs. I mean, the tariffs are driving
Mhm.
construction costs in California. Where does our timber
Yeah.
come from? It comes from Canada. Where does our gypsum come from? It comes from Mexico. I mean, this is a huge problem.
Nancy, your position, your background dealing with this, that you are in contact with a lot of the regulatory officials, I understand,
Yeah.
in California, and you
Yeah.
are dialed in with that with your position at UC Berkeley.
Yes.
Is the trend to become more regulated? Is it to ease up
So
on the regulator, let the market take care of it? What do you see?
it's an interesting question. I was going to sort of interject earlier. I mean, we also are looking at the privatization of Fannie and Freddie. And Fannie's a huge multifamily funder. And so the rules that are going to be true under Fannie Mae in conservatorship are very unlikely to be the rules going forward very shortly, because I do think the privatization is going to happen under the Trump administration. So Fannie and Freddie have been very lax. Actually, they have not been requiring a, a very stern look at risks, either an earthquake or wildfire or hydrological risk, hurricane. And that may change with private equity being very involved in their funding, having now having to report to the stock market on a quarterly basis.
Yeah.
The world may change a lot in that major funding source. So I think it's also what's going on in banking regulation and what the requirements are going to be for mortgages.
That may be changing too, because we had received a letter from Fannie Mae on a loan on a property we manage with Fannie
Yeah.
Mae loan, and they want all those clauses that John had mentioned earlier. They want the warranty of habitability in the policy. They want the molestation. They want the handgun.
Yeah.
They want all
Yeah.
those coverages. And giving it to an insurance company, they're going, that's nice, Robert. I want world peace. I don't know how
But
you're
that's
gonna,
because
I
they're
don't know how you're going to do
privatizing.
this.
But Robert, you're exactly right. I mean, the big push to privatizing is going to be a big push to ask for all of that, because
Yeah.
that's what the capital markets want. Yeah.
And I think on the property side, the lenders have gotten, I'd say, less stringent around hurricane coverage. Historically, lenders required, if you think about all risk insurance, and that's kind of the standard requirement, that includes everything but earthquake and flood. Those kind of
Yeah.
fall outside,
Right.
and those are always going to be sublimited and aggregated, where everything else is per occurrence. Historically, lenders required you to buy 100% of your total insurable value for a named storm. In
Yep.
recent years, that insurance has become unaffordable. So lenders are now allowing you to buy that insurance to a return period based on a probable maximum loss. So they're looking at cat modeling, and it's typically somewhere between 250 and 1,000 years. You are seeing
Yep.
some lenders still push higher than that, but I would say it's 250 to 1,000 for named storm. Earthquake has always been that 500-year PML, but only if you're at that 20% SEL. I think, Robert, to your point, what you've seen in this guidance that's come out from Fannie and Freddie this year is they're coming out, and there's been a lot of press about this, saying we need affirmative coverage for sexual abuse and molestation. We need
Right.
affirmative coverage for assault and battery. It's interesting. I think that many people have said they're getting so much more stringent. I think what's actually occurring is they've those those coverages were always built into a general liability policy. And
Right.
I think that in their mind, they're not changing their stance. What they're learning is that these things are being excluded and they're not being told about them. And that's
Oh,
finally coming to their
Mm, there
attention.
it is. Yeah.
And now they're
Yeah.
having to come out and affirmatively say, I need these. Like these were always a requirement. It was just, I didn't know that I needed to explicitly put it in there. It happened recently with property insurance because there's a lot of creative structures on the property insurance side that people have been doing for more than a decade, and they just haven't been showing to the lenders, and they've been issuing certificates very creatively to kind of hide the ball.
I did, yeah.
And now these lenders, they're increasingly outsourcing insurance diligence for loans
Yes.
to more sophisticated people who are saying, I don't just want your certificate of insurance. I want to review your policies. I want to review your statements of values. I need your modeling. So they're asking a lot more questions. And what they're finding is that things that they thought were covered are now not covered. So they're coming back and explicitly saying, like, this
We
was always
must
a
have,
requirement. I'm now just, I'm hammering it into you. But it
Yeah.
is a challenge
Right.
because they're affirming that coverage at a time where it's increasingly unavailable, particularly in markets like California, where, I mean, San Francisco habitability, you can't get it. Like it's a reality of the nature of that market and the judicial environment that it's almost an impossibility unless you're buying brand new, trophy multifamily buildings.
yeah.
Right.
Sure.
And I think, I mean, to your regulation question, with privatization, Fannie and Freddie are going to be much less out of the reach of regulators. So I think market forces are going to have a lot more to do with what their requirements are, which is going to be a new world for a lot of borrowers.
Two comments. You had mentioned and brought up master insurance policies before, John, and IPS is just in the finishing stages of putting together a master program for all of our clients.
Mhm.
We've got the portfolio size, we've got clean loss runs for it, where all those coverages that we had mentioned, the habitability, the handgun, the sexual molestation, that will be included in the master insurance policy. And the blanket limit, as you had touched on, I think we're looking at a minimum of $250 million for that. So we're moving toward that to protect the clients. It's just a thing to do. And the other comment I would have too, you had mentioned insurance companies, they are not shy. Their inspectors are more than happy to come out and go, you know what, your sticks on your second floor balcony, they need to be closer than 4 inches. That's been around for a few years. They go, your pool fence is not tall enough, fix it. Your pool gate is not strong enough, and we don't think it closes 100%, 24 hours a day. Fix it. And some of these insurance companies are just going 30 days, do it, or you're canceled. Or
Yeah.
sometimes in the past, you've got 30 days to report back to us on what you're going to do, or that you may have to do it. It's a
Yeah.
recommendation, not a requirement. And some of the insurance companies fix it in 30 days or you're canceled. And the last thing a property owner wants is a cancellation on their insurance history. That drives insurance underwriters, carriers crazy.
And I think, Robert, to your point, I think one of the benefits of the blanket program structure, you have a little bit more leverage with the markets, and the markets tend to be they're still going to come out. They're going to inspect the properties. They're going to provide those recommendations, but they tend to be a softer in the sense of, you need to respond within 30 days. And as long as you're providing a response of, here's my plan to address those, there's a little bit more flexibility. There isn't this hard line in the sand of do this within this time period or we're out. There's an expectation of doing it, particularly around pools, because
Yeah.
these days it's shootings and drownings, unfortunately.
Yeah.
We've seen people squeeze through, holes in fences. We've seen gates that don't lock. Like those are the catastrophic claims that occur.
Mhm.
And these carriers, the benefit that they have, if you think about it from their perspective, is like they're paying all these claims, they're seeing these losses, they have so much data around, these are what's driving our losses. These are the drownings. What happened when this drowning occurred? Okay, the door didn't lock. These gates weren't high enough. Balconies are a huge issue for
Yes, yes.
Yeah,
for
balconies.
insurance companies.
And that's where
So a
that's where
lot
we've
of this
seen
is,
fix it or we're gone. Yeah,
Mhm.
we've
Yeah.
seen it on balconies. Yeah. Clay, we're coming up on
and
an
it,
hour.
and it's
Yeah, we are up at our hour here. I want to give both of you an opportunity for maybe a final word. If you want to, take 30 seconds to a minute to jump on your soapbox and tell everyone where regulations going wrong, where landlords are going wrong, where the insurance market's going wrong, or what's going well. So, Nancy, I'll let you go first.
This has been very interesting for me as well, but I do have to stick with my regulation hat that
Yep.
premiums are going to rise in California. They just have to. We're coming up on an election for the new commissioner of the California Department of Insurance. And I think there are going to be changes in the state in terms of how we view the pricing of electricity, of insurance. And obviously it's also related to the electricity grid and how risky it is. And so I think those issues are going to have to be dealt with. And that's where I think that mitigation may be the solution for some property owners, because their properties basically have to be retrofitted to afford insurance.
Yeah.
Yeah, and I think mitigation is right? Like if you think about insurance in the long run, it's a cost plus business, right? Insurance
Exactly.
companies need to cover their expenses, and they need to make a profit. And
Correct.
there's a lot of volatility, but over the long term, if you think about it as a cost plus business, what's the best thing that you can do to keep your pricing down? Don't have claims, right?
That's exactly right.
How can I create program structures where maybe I'm taking a little bit more defined risk, which I can quantify? How am I upgrading my properties? Nancy, to your point earlier, if my roof is 20 years old, get a new roof, right? Because the carriers are going to put restrictions on your
And
roof.
that's where I think I can help, because I think we can get the capital markets to actually start designing mortgage products to help people do just that. Because the mortgage market is not very well structured to be responsive to mitigation. We just don't have those products. But there's good news here. I mean, we're working with banks, and there's interest. There's real interest.
Yeah. And I think the last thing is that if you think about insurance as a market, right, everybody's competing for dwindling capacity. So as you go out and you're acquiring insurance, you need to think about what you can do when you're delivering your portfolio to the market to stand out from your peers. It's, when you're replacing your roof, you have to make sure that your broker is telling the markets, we just put a brand new roof on this building. If you're doing upgrades to your electrical, to your HVAC, if you've made repairs to your balconies, that information needs to be presented to the market. One, to demonstrate that you're a good buyer of insurance, a good landlord who's going to operationally mitigate claims. But two, when these carriers are underwriting your risk, they're taking your information, they're plugging it into an actuarial model, and it's spitting out results. And there are all these data inputs that you can add that are going to lessen the uncertainty in that model and ultimately improve the pricing. So it's very heavy on data.
I agree with what he's saying. And I do think the California Department of Insurance is going to be responsive to that. And ultimately, there could be menus of discounts as quid pro quo for certain kinds of mitigation. And I think that's hopefully where we'll go.
Interesting. Well, I want to thank Nancy, John. Thank you guys both for joining us. And obviously to all of our viewers, thank you for taking the time to watch, and we hope it was informative.
Thank you.
Thank
Thank
you.
you, everyone.
Thanks.